Well, good evening, ladies and gentlemen. Welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. Now, tonight I actually wanted to build on one of my previous videos, and that's the one where I talked about compound interest, and how if you invest $40 per week and get a 9% return, over 45 years, you'll end up with over $1 million. But I want to actually talk about this a little bit more because I've got a few questions about how I got these figures and how one actually might invest $40 per week. Okay, so I talked about the really magical power of compound interest and what it can do to your wealth. But let's have a look at this equation here. So if you invest $40 per week for 45 years and a 9% interest rate, you will end up with over $1 million. But where did I get this 9% rate of return from? Well, I actually just pulled it because it's the average number that an index fund will return over a very long period of time, say 10 years or more. Now, this rate varies between 8 and 10%, so I just went with 9%. So if you invest your money in an index fund or in something that will at least get you a 9% rate of return, you will end up with over $1 million. So what do I mean by an index fund? Well, an index fund is just a fund that tracks the market return of an index. So an index is just another word for a group. And the most common index in Australia is the ASX 200. So that follows the top 200 companies in Australia. And this index is given an historical rate of return of about 9%. So if you put $40 a week into an index like the ASX 200, for 45 years, you can reasonably expect to get over $1 million at the end of that 45 years. Likewise, if you invest in the S&P 500, which is the most common index given to the United States of America, so that's the top 500 companies in the United States of America. This index will also usually give you a rate of return of about 9%, sometimes a bit more, sometimes a bit less, but if you take the average over a very long period of time of most indexes, you will get a number very close to 9%. So the main problem you'll have with investing $40 a week into an index fund is actually buying the index. So an index is normally traded as an ETF or exchange traded fund. That means that you can buy and sell shares of the index on the stock exchange. Now, normally when you buy and sell shares on a stock exchange, you will have to pay what's called brokerage every time you buy or sell. So brokerage is just another name for a fee or a charge for buying and selling shares. And most brokerage fees are between $15 and $20. Now, this of course brings up the question, if you want to invest $40 a week, it's not really going to be worthwhile if you're paying $20 in brokerage to invest the $40. And this is one of the problems you'll have if you try to follow this strategy. Now, most people who want to invest consistently, like $40 a week, will usually use a strategy something like this. You might want to set up a direct debit of $40 a week into a separate bank account. Now, the best way to do this is just to set up an automatic plan where, say, every Thursday, $40 is taken out of your bank account and put into a different bank account, one that you don't pay attention to. So once you've got that set up, then decide on a time frame, say every 3 or 6 months, and at the end of those 3 or 6 months, take all the money that's accumulated in that separate bank account and then go and buy the shares in the index. So instead of paying a $20 brokerage on a $40 investment, you'll be paying a $20 brokerage on, say, a $500 investment. And that way the cost of doing this is dramatically reduced. And you can do this every 3, every 6, every even 9 months, every year. But the most important thing is to put that $40 a week away and then make sure you invest it. And you have to do this consistently because that's the only way to get this 9% return. If you've heard that the stock market's had a huge crash and everyone's losing money, a lot of people might want to stop putting the $40 a week away because they can see the value of their shares they've already invested falling. But this is the worst thing you can do because all a stock market crash does is make shares cheaper, make indexes cheaper. So that means for every $40 that you're spending, you're actually getting more shares. So why on earth would you stop buying the shares when they go on sale? So this is actually a really easy strategy to follow. Start putting that $40 away in a separate account where it won't get your attention and tempt you into spending it. And then every 6 months, just head over to your broker app. Make sure you sign up for one of those. You'll need that to start investing. So all the major banks have their own. Commonwealth Bank have CommSec, NAB have NAB Trade, and Westpac and ANZ have their own versions as well. So make sure you sign up for those. And every 6 months, just open up that app, open up that CommSec app, put in an index fund such as VAS, that's that ASX 300 that I was talking about earlier, put that symbol in and buy the $500 that you've saved up worth of VAS shares. And then if you follow this every 6 months and do it for 45 years, you will end up with $1 million. So that's how you need to get started if you want to follow this path. Alright guys, thanks so much for watching. If you found this video useful, make sure you leave a like on it, and if you haven't already, make sure you hit that subscribe button. I'll be back soon with some more videos, but for now, good night.